Welcome to Galaxy. In today's video we're diving into a topic that has been on everyone's minds lately, inflation. With rising prices and a fluctuating economy, it's crucial to understand how to not only navigate but thrive in such challenging times. In this video, we'll be exploring some practical strategies and valuable tips on how to make money during inflation. Before we jump into that, let's take a moment to understand what inflation really means. How inflation affects some countries in the past, and the effects of inflation on international trade. Inflation is the increase in the general price level of goods and services over time. It means that, on average, things get more expensive as time goes on. But have you ever wondered why this happens? There are several causes of inflation, and one of the main drivers is the increase in the money supply. When there's more money in circulation, people have more purchasing power. As demand rises, businesses may increase prices to maintain their profitability. Another cause is the demand pull effect. When there's strong demand for goods and services, companies may struggle to keep up. This can lead to price increases as businesses try to balance supply and demand. Additionally, rising production costs can contribute to inflation. When the cost of raw materials, labor, or energy increases, companies often pass those costs on to consumers in the form of higher prices. Now that we understand the causes, let's explore the effects of inflation on the economy and individuals. Firstly, inflation erodes the purchasing power of money. As prices rise, the same amount of money buys us fewer goods and services. This means our savings may not stretch as far, and our standard of living can be affected. Another effect is uncertainty. Inflation can create an unpredictable economic environment, making it challenging for individuals and businesses to plan for the future. This uncertainty can lead to reduced investment, which can hinder economic growth. While inflation may seem daunting, there are measures that can be taken to mitigate its impact. Let's explore a few strategies. Central banks play a crucial role in managing inflation. They can adjust interest rates to influence borrowing and spending. By raising rates, they can slow down economic activity and reduce inflationary pressure. Governments can also implement fiscal policies. These include measures such as controlling government spending, reducing budget deficits, and managing public debt. These actions aim to stabilize the economy and prevent excessive inflation. On an individual level, there are personal finance strategies that can help mitigate the effects of inflation. Investing in assets that tend to increase in value over time, such as stocks, real estate, or even education, can help preserve your purchasing power. And there you have it. The inflation, though complex, can be understood by exploring its causes, effects, and measures to mitigate its impact. Remember, knowledge is power. The more we understand inflation, the better equipped we are to make informed financial decisions. Some countries experienced inflation in the past. The hyperinflation that indeed occurred in various countries throughout history. And studying these cases can offer valuable insights into the causes and consequences of such economic crises. Here are a few historical examples of hyperinflation and some key lessons learned. Zimbabwe, 2008-2009. Zimbabwe experienced one of the most severe hyperinflations in history. The primary cause was the government's reckless printing of money to finance its budget deficit. The hyperinflation led to a collapse of the Zimbabwean dollar, widespread economic turmoil, and social unrest. One of the crucial lessons from this case is the importance of maintaining fiscal discipline and avoiding excessive money creation. Venezuela, 2016-2019. Venezuela's hyperinflation resulted from a combination of factors, including over-reliance on oil revenues, fiscal mismanagement, and economic policies that stifled productivity. Inflation soared to astronomical levels, causing widespread poverty, scarcity of essential goods, and mass emigration. This case highlights the importance of diversifying the economy, implementing responsible fiscal policies, and maintaining a stable monetary system. Now let's talk about the United States. To understand the causes of inflation in the United States, we must explore several key factors. First and foremost, one of the primary drivers of inflation is excess demand or demand pull inflation. This occurs because the overall demand for goods and services outpaces the economy's ability to supply them due to COVID-19 shutdown. When consumers have more disposable income due to factors like tax cuts or increased wages, they tend to spend more. This surge in spending places pressure on businesses to produce more, resulting in increased demand for resources such as labor and raw materials. As demand surpasses supply, businesses may raise prices to balance the equation and maintain profitability. This process can trigger a sustained increase in the general price level, leading to inflation. Another significant cause of inflation is cost-push inflation. This occurs when the cost of production for goods and services rises, forcing businesses to pass on these increased costs to consumers. Increases in the cost of labor, raw materials, energy, or transportation can squeeze profit margins for businesses. To compensate, they may adjust prices upward to protect their profitability, thereby contributing to inflation. Lastly, monetary factors, particularly the actions of central banks, can influence inflation. When a central bank, like the Federal Reserve in the United States, increases the money supply rapidly, it can lead to an excess of money in circulation. As the money supply expands, people have more money to spend, which can fuel demand-pull inflation. These historical examples provide important lessons about the consequences of hyperinflation and the importance of sound monetary and fiscal policies. By studying these cases, policymakers can better understand the dangers of unchecked money creation and the necessity of maintaining economic stability to avoid such devastating crises in the future. Inflation can also have significant effects on international trade, influencing various aspects of the global market. Let's explore some key concepts that might be discussed in the series. Purchasing power parity, PPP. PPP is an economic theory that suggests exchange rates should adjust to equalize the purchasing power of different currencies. In the context of international trade, PPP can affect the competitiveness of countries' exports and imports. Changes in inflation rates between countries can impact relative price levels and alter the exchange rates, thus affecting trade flows. Exchange rates. Inflation can influence exchange rates, which, in turn, affect the cost of imports and exports. When a country experiences higher inflation compared to its trading partners, its currency tends to depreciate. This depreciation makes its exports relatively cheaper and more competitive in foreign markets, while imports become relatively more expensive. Conversely, if a country has lower inflation, its currency may appreciate, making imports cheaper and exports more expensive. Pricing strategies. Inflation can also impact pricing strategies for businesses. Making money during inflationary times can indeed be challenging, as rising prices erode the purchasing power of money. However, there are strategies that investors can employ to navigate and potentially benefit from such periods. Here are some key insights and considerations for investing during inflationary times. Diversify your portfolio. Diversification is a fundamental strategy that can help manage risk and potentially provide returns during inflation. Allocate your investments across various asset classes, including real estate, commodities, stocks, bonds, and alternative investments. This approach can help mitigate the impact of inflation on any single asset class. Real estate. Real estate has historically been considered a hedge against inflation. During inflationary periods, the value of real estate tends to increase, as property prices rise along with the general price level. Consider investing in real estate investment trusts, REITs, or real estate-focused mutual funds or exchange-traded funds, ETFs. Commodities. Commodities, such as gold, silver, oil, and agricultural products, have also been regarded as inflation-resistant assets. These tangible assets have intrinsic value and can provide a hedge against inflation. Investors can gain exposure to commodities through commodity-based ETFs, futures contracts, or by directly investing in commodity-producing companies. Stocks. Certain stocks can perform well during inflationary times. Look for companies that have pricing power and can pass on increased costs to consumers. Industries such as energy, utilities, consumer staples, and infrastructure tend to fare better during inflation. Dividend-paying stocks can also provide a potential income stream that may help offset inflationary pressures. Hedging techniques. Explore hedging strategies to protect your portfolio from inflationary pressures. This can involve using financial derivatives, such as options and futures, to hedge against rising prices. Additionally, inflation-sensitive investments can be balanced with fixed-income assets, like bonds, which may perform well during deflationary periods. Regular portfolio reviews. Stay vigilant and regularly review your investment portfolio during inflationary times. Market conditions and economic factors can change, requiring adjustments to your investment strategy. Monitor inflation indicators, such as Consumer Price Index, CPI, data and central bank policies, to make informed investment decisions. Remember, investing strategies should be tailored to your individual financial goals, risk tolerance, and investment horizon. It's crucial to consult with a qualified financial advisor or investment professional who can provide personalized guidance based on your specific circumstances. In conclusion, navigating the complex landscape of inflation can be challenging. But it also presents unique opportunities to make money and secure your financial future. Throughout this video, we have explored various strategies and techniques that can help you thrive during times of rising prices. From investing in assets like real estate funds and commodities, to exploring alternative income streams, there are numerous avenues to explore. By diversifying your portfolio, staying informed about market trends, and adapting your financial approach, you can position yourself to not only protect your wealth but also capitalize on the changing economic landscape. Remember, knowledge is power. Stay connected and informed by subscribing to our channel, like and share the video. By doing so, you'll gain access to valuable insights and practical tips that will empower you to make informed financial decisions. And hit the notification bell so that you never miss an update. Thank you for joining us today, and we look forward to continuing this journey together. Until next time, stay proactive, stay informed, and let's thrive in the face of inflation.